Stock started the week off with a bang today and almost made it to where we did not have a negative first 5 days of January. That's that second seasonal factor. We started off with the Santa Claus rally not being positive, and now we were, 70 points away from the roughly from the first 5 days indicator from being net positive again, and this seems like the market was on a mission to make it today with a rally throughout the day. Didn't quite make it, so we ended up being negative. And now we have that third seasonal indicator, which is the full month of January, as to whether it's going to be up or not, as to give us an indication of just how bullish we'll be here for the calendar year of 2024. So we're going to break down today's rally just to see, was it, a bounce? Was it this type of nice little rally where things have changed? All these technical signs we've been watching for, have they changed back to the upside now to where we can continue to trend? Did we get enough of a pullback? Did we have an intermediate pullback? Was this just a near-term pullback? How much, if it is the latter, how much longer? How long will a new near-term rally last? How much longer does this intermediate rally have, considering the parabolic nature it had throughout the last couple of months of last year? We'll take a look at all those things, what's driving the action today specifically, and then our trade ideas, a stock that looks very much like the market as a whole, has its own nice little bounce today, and we'll talk about how to trade that. So let's go ahead and get started. Today is Monday, January the 8th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel. This icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. Join our Market Outlook Facebook group that we've created. All right, if you're watching us on our website, come down here on the right-hand side, click on any of these things over here, including a Market Outlook Live. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So it's a big deal for us. That's why we always ask. So thank you to those who like these day in and day out. Those who don't, you can do it right now while you're watching. We can try to get that number from 59 all the way up to 100, which is our goal every day. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see a big bounce up to the upside. It really came, the market tried. I remember thinking, I'm telling some of my classes here at Market Scholars that, to break that first 5 days, for it not to be negative, it's got to go up like 70 points, whatever. And, it's considering how small the ranges have been, it's probably not likely. Well, we got 64 points. We went up 66 points. Like, that was we came that close. 47.69, 83. We finished at 47.63. We finished down 6 points in the first 5 days thanks to this rally. So the market really tried. It seemed like there was some effort there to try to make it up, right? Make up that particular, it's a very specific number, but of course it seemed like we were trying to make that up and came very darn close as the momentum line spiked up to the 99th percentile. The near-term line jumping back up. Both of them coming from strong lows, still up above the moving average, 30-day moving average now by about 2%. The near-term line not back above the intermediate line yet, but probably, unless we reverse today's move, there's enough momentum there to carry the near-term line. Usually the momentum line carries it with it, so there's enough momentum here to get that near-term line up there. Again, barring like a sharp drop back down to zero by that same red line, the momentum line. So very strong move. Very good move, exactly the kind of move we want to see to maintain this bullishness and get this bull tag bounce trade, which is what we got. Again, momentum line spiking. The near term line did jump above the intermediate line here. That's exactly what you want to see. Your Russell 2000 wasn't as bullish, but still, because it was more bearish. The near term line did not cross above. Remember, the intermediate line has crossed below its market sentiment. Short-term sentiment has not crossed back up above the intermediate line yet, though you are still nearly 3% now above the 30-day moving average. Then your Dow Jones got hit pretty hard by the Boeing news, so not as big of a bounce, but also didn't have as big of a dip either during this 5-day decline. In fact, if you look at its 5-day move, we were barely down, just less than 100 points. 37, 689, 37, 683. So 6 points is really all we were down here, and that's again, 6 points on 37,000 is a much more minuscule number. Of course, the intermediate line is actually still above the 90th percentile. Some of the other intermediate lines are down further in bullish territory, but this intermediate line is actually still above the 90th percentile. Market sentiment lines now rising pretty strongly in this upper reversal zone. Short-term sentiment bouncing. So nice, good start to the week. This is kind of harkens back to those to these prior weeks when we were bullish, even back over here where like every single Monday was an up day. Very good start to the week from a market forecast standpoint. Let's take a look at the weekly chart here. And you can see again, we have another transition candle thanks to this rally. We end up with a new transition candle here to the upside. It's only 1 day, but as of right now, that's a nice, that's the kind of transitions you would like to see to be able to maintain the bullishness, right, and avoid the consolidation to the downside. The Hakunashi differential is still below its moving average, so we're not out of the woods yet here, but PPO is still rising. We're above that rising 10-week moving average, so that's a good sign. You still got 2 red arrows on the S&P, and pretty much everywhere else, but at least we're rising. At least the histogram you see is rising on all of these. Now it was a pretty bearish momentum, so keep that in mind. But that's a good bounce up here. Now it's below average, it's above average on the range, way above average on the range. That's a tremendous move on a very, very small range. But but below average on the volume. So the volume is really ticked down here to the downside. When you look at the 2-line versions of this, obviously you're back above the 8-day after briefly being below the 17, but still above the 30. You're back above the 8-day. There's still a pretty sizable gap between these averages. IWM also, because it was actually down further, it also is back at least close to its 8-day moving average. The Q is back above its 8-day moving average as it's actually still in its value area, but hitting the 30-day moving average and bouncing is a good sign for it. Let's take a look at some of the other oscillators. The DMI bounced back in the positive direction as we're back above 25 with a positive indicator and back slightly below 20 on the negative indicator. ADX is still very strong, hence the bigger move. Right now the Q's looking very similar, though the negative indicator is actually just barely below 25, but your ADX is still pretty darn high there. IWM looks a little different in that the positive indicator never did dip below 25 and still above it. The negative tried to make a run up above it, got up to 25 and back down. You can see kind of the bounce signal that we're seeing here. Looking at the RSI and the CCI, back above 60 with the RSI, back almost above 0 with the CCI. Bounce signal, exactly what you like to see. Russell's a little bit further, was more bearish on this decline, so it hasn't been as positive to the upside. And you remember the Dow Jones never was as bearish, right? So you're back above 70 on the Dow, just like that, as you never really did get significantly below 0, much less below minus 100 on the Dow Jones Industrial Average. The Ichimoku trend cloud ended. The trend ended for the NASDAQ, and you're bouncing back up down there. Did not end for anything else. So the S&P 500 and the Russell still maintain their bullish trend. So we're still okay in the meantime here. You'd like to get back above that green line at the very least to get going back on a new trend. You can see, we're back in the 80th percentile. We don't have a new 4-week low point yet. When you look at let's look at the Bollinger Bands first. You did get back into the upper quartile. The momentum never did shift, and the bands never did get inside the Keltner channels yet. So keep that in mind. We might not be out of the woods yet when it comes to that. Now let's take a look at the 4-week range. Again, we didn't get a new high today, but we are now closer, a lot closer, to getting a new 4-week high point with the rally that we had here throughout the day, and then closing above, briefly above, last week's high point. So a major move to get above last week's high all in a single day. But remember now that low point is going to start moving up, and it's been a while. Now we're below number 70 on the Arun indicator, so that's setting us up for, and again, barring a new high in the next day or two, it's setting us up for a reduced 4-week range. So we're not out of the woods. We need to get through the new highs. Ideally, we need to get to all-time highs. There was a tweet I put out there that when the market gets within 2% of all-time highs, after having obviously been below that, you tend to get new all-time highs within a month, and that was back on December 13th. So we're going on a month now. So ideally, we get new all-time highs here in the next few days, so you can be able to maintain that particular signal. Obviously, the volume in the trading range, you look at the range here, 6.5 points with 75 million shares trading hands. When you look at those numbers in context, 6.5 points is way up here. So a big move higher is bringing the range back up towards 1%. Again, that's not typically bullish. The volume is at 84 million, and it has been rising. So again, it's not necessarily the most bullish sign. I mean, obviously it's a bullish day today, but it's a really big move when we didn't really have we didn't have a high VIX that we were coming down from. We were barely above 14. We were barely above 85%. In fact, you can see that the correlation with the VVIX is way down. It's back easily below the 50% mark. And again, when the VVIX has a negative correlation with the VIX itself, that tends to precede an increase in volatility. With volatility having briefly been to the upside here, you can see with today's move, you're back towards the 30-day moving average. You can see we've had these big down days in volatility, and they haven't stuck. So let's see if today sticks or not, and we get more of a sustained decline. Without a whole lot of room to go, but if we can at least stay down, then that will help us be able to just grind higher in the index, as we're coming off that parabolic peak that we ended the year with. All right, now let's take a look at what's driving a lot of this price action. You can see a common theme here is over the past 3 months. Most likely, that's the theme that we'll see on a nice, good bullish day like today. If you take a look, we had commodities down, we had the dollar down, we had bonds up. That's a bullish story for the past few months, and wasn't as bullish as the dollar wasn't that bearish. Though commodities started the day down 2%, ended up off their lows. It's still down 1.5%. Of course, gold dropping with despite the drop in the dollar, kind of following along with commodity prices. Bonds were not as strong, though they finished with a flourish there at the very end of the day today. But that didn't stop the Qs, IWM, real estate from really doing well. You can kind of see here it goes all the way back really to the last day here, in the last day of December, when we had some strong weakness and Qs and IWM, some strength in the dollar, and commodities being relatively strong, and you can see why that puts some pressure on equities, and the bonds were down too, and so it's kind of more of just an oversold bounce that we're getting right now. When you look at TLT had been coming down towards its moving average, very similar to the S&P 500. As of right now, bouncing off of that. On the other hand, some of the other asset classes like the dollar being in a much smaller range than what we saw the previous day, but down slightly. Trying to see whether or not it will continue to go down below its 8 and 17-day moving averages. Of course, commodity prices are way down. Now, granted, this is a little different story for commodities because they've already been relatively parabolic to the downside, as we saw with the prior video with the DMI as bullish as it is and the ADX rising there. And then you gap down as significantly as we did today. When you look at, obviously the major component of DBC would be crude oil. And crude oil You can see was down, though not breaking down, still hovering around the point of control. And that's really important for crude oil to see whether or not it will actually break below this kind of like $67 area and continue to drop further, or if it's going to continue the basing pattern that it's had and work its way off of the strong support level back to the upside. And today's move is more of a noisy type move than it is anything else. Yields, which had been ramping back up to 4%, ended up finishing the day slightly above 4%, but also still above these moving averages. So again, today's move was less of a bounce than what the equity market was. So the equity market kind of jumping on this a little bit more than what some of these asset classes are kind of driving it to be. Of course, it's not going to be surprising to see the cyclical areas of the market jumping up the most today. If I were to go back here just to January the 8th, you can see XLK, XLY, XLC with real estate. All the best performing asset classes today. Energy obviously down 1%, though well off of its lows. It was down 3% this morning, so well off of its lows there. Some of the other cyclical areas like industrials and materials and financials kind of matching the safety trades that had been doing so well. Again, going back to the last day of the year when things started to turn south for the markets. Again, you can see XLK and XLY jumping as much as they did. There's a reason for it to be jumping as much as it did, and because they were so oversold, and you still have some gains again over that period of time for XLV and XLU. If I just go year to date, because remember you got the first 5 days kind of a thing here going on. Here's our first 5 days of the markets. Again, SPX almost making the round trip all the way back to gains for the 5 days, but finished with a loss. XLK, XLY down 2% still. And then you have XLU and XLV, your safety trades, up 2.5% to 3%. So again, kind of as of right now, an oversold technical bounce, and we need to see more. As I mentioned to you before, when you get up to 2%, right here is when we finally kind of broke within the 2% of the all-time high. All-time high being, let's see, going back here. Let's go 3 years. Right here, so the all-time high being at 48.18, and we're at 47.63. So we have pretty much a week to be able, within a week, to be able to get to that all-time high. Because again, as you can see, it's the first time that we've been within 2% of that this entire time. For pretty much 2 years now, it's been since we've had a new all-time high, which is very rare unless we are actually in a bear market, which of course we never really did get into a bear market there in 2022 because of how bullish we've been going into that, right? If you look at the weekly chart, which a bear market is an extended run below the 200-week moving average, you can see we just basically got to the 200-week moving average, so which is what a correction is, a pretty decent correction, and it bounced back up, and you can see the positive momentum, despite a falling histogram there, the positive momentum still, we're still well up above these moving averages, and there's that 9-week rally to the upside that we gave back some of those gains. But even with, when you look at these returns over that certain amount of time there, even with this small little decline, when you look at the rate of change going through today, so this would be, let's see, 48-day rate of change here. You can see it's still a pretty decent return, considering, we're at 15.69%. That's still a very high level for this amount of time. It's, very, as you can see, it's very uncommon to get this high of a return, basically 15.7% here. Fat fingering everything I put in here. But 15.7%, obviously COVID was higher, and coming off this 2019 level was higher, but 2011 we had this kind of a move. 2010 we also had this type of move, and you can see coming off of 2009, obviously. But it's other than coming off of high runs where the VIX is really high, which remember as we saw was not the case this go around. We never did get a high VIX during 2022. We were slightly into the low 30s, but we only closed 1 week above 100% relative to the VIX 3M. Much less above 105 or 115, which is where we finished all those other instances that the markets made this type of rally over, like I said, a 48-day window, almost basically a 10-week window there if you're looking at 50 days. Let's take a look at the breadth here. The new highs and new lows index got back from being at small negative levels, so they're back to being positive, though it's still very small positive levels and still below the moving average there. You can see the number of stocks above the 50-day moving average also jumped back higher, slightly above, and a pretty extremely high 20-day average. So we haven't broken down below that. Same thing with the number of stocks above their 200-day moving average. The skew, take a look at the skew. Instead of going up on a day like today, which can do whenever you've had these kind of, when you're still at these highs, it's still below its average and actually fell today. So the skew remains in this level where it typically puts pressure on equities, as we've seen over the past couple of years, being below its own moving average. Look at other breadth indicators that we look at here. The McClellan oscillator in particular, still slightly negative, so we're down below minus 1,000, but we're obviously still very strong levels. The money flow is also something we pay close attention to, and you're still in bearish levels despite today's rally. Still in bearish levels on the money flow index down there, the oscillator, being below 50. So you need to get back above 50 and ideally get back above 60 to really confirm this bounce and maintain. You can see when you're on a nice solid trend, you can stay above 50 pretty much that entire time, and that's what we need to follow through with by the end of the week here. All right, for today's trade idea, I wanted to take a look at CrowdStrike. It looks very similar to the market, just didn't have as big of a dip. The intermediate line just barely getting outside the upper reversal zone. Market sentiment has been strongly in the upper reversal zone for multiple weeks now. The near-term line crossing back above the intermediate line, well into the reversal zone again itself, up 6.5% above, closing above multiple days highs. Good, strong move to the upside. When you look at the weekly chart, again, we had gone bearish. We have a very high long-term PPO here for some context. Let me zoom out a little bit. That's a very, very high level between the 10 and 40-week moving averages. So we're not going to make a strong directional move on this trade, but there is some opportunity for a bounce as you see multiple moving averages showing decent move to the upside. Closing above the 8 and 17 day, 30 still going up 50. We're still well above the value area at some point in time. And it's not a very good margin of safety. So it doesn't feel, that's why I don't want to be too aggressive here, because we're kind of trading in a tenuous trend here considering how parabolic we've gone. You see that as well. And the DMI, I mean, you get these parabolic moves. The ADX got above 60 for CrowdStrike. They don't tend to unwind very comfortably. Some other trend strength indicators, you can see how strong they are. Very, above a 17. Again, for some context on CrowdStrike, that's about as big as we've gotten. And you can see after we peaked over there, we just kind of had about a 6-month period where we didn't do anything. Had some volatility there, but as of right now, the trend remains very strong. You can see here almost back above 70 again on the RSI, well back above 0. As you can see, the weekly CCI is still at positive levels after having crossed above 100. Way over here, actually, is back over here where we crossed above 100 and really started to break out to the upside and took off on a nice solid trend there over however many weeks it's taken. The Bollinger Bands, the move today broke above the upper Bollinger Band. That with a bandwidth that's really come in inside the Keltner channels, the red dots, But today we close above the upper band and the upper Kellner channel. So nice kind of breakout move on that. So what we decided to do here was come to the February options and to sell a bull put spread at that 30 delta. We ended up doing the, what would that be, the 250, 240. So when you look at it here, you can see about a $265 for 735. You need 232 at least to get a 30% return on risk. So we're above the 30% mark and a decent probability. You can see that break even is here on the intraday chart. We basically have to reverse today's gap, fill in today's gap, which is essentially looks like a runaway type gap. We'd have to reverse all of that and then some for us to get to the point where we lose 265, which is what we're willing to lose on a trade like this. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.